Solana is suddenly on everyone's radar, and with good reason. Over the last year, Sol has staged what can only be described as an epic recovery rally, doing over 7x since FTX collapsed last year. Most of these gains have happened over the last few weeks, and it's left everyone wondering why Sol has been pumping so hard. That's why today we're going to bring you up to speed about what's been going on with Solana and tell you where Sol could be headed next. Okay, I'll start by saying that nothing in this video is financial advice. It's purely educational content that's intended to assist you on your crypto quest. I'll also note that I, as well as some other Coin Bureau team members, hold Sol in our personal crypto portfolios, but I promise to be as objective as possible in my analysis. Oh, and if you're looking to pick up some Sol yourself, then you'll want to check out the Coin Bureau deals page. Over there, we have trading fee discounts of up to 60%, as well as up to $40,000 in sign-up bonuses from some of the best exchanges. The link is in the description. Now, that said, let's start with a quick recap. Solana was founded in 2017 by former Qualcomm engineer Anatoly Yakovenko. It was built by an American software company called Solana Labs, and its continued development is coordinated by a Swiss non-profit called the Solana Foundation. Now, Solana's endgame is to be a decentralized competitor to centralized stock exchanges like the Nasdaq. In a recent interview, Anatoly noted that this is still the endgame of the project, but also noted that its purpose has broadened to include other use cases, namely DeFi, NFTs, and crypto payments. As a fun fact, by the way, Solana is apparently the official blockchain for Circle's USDC. This was according to a blog post by the Center Consortium, an entity which consisted of Coinbase and Circle and governed USDC. The caveat is that the Center Consortium was dissolved in August, and it's not clear if this is still the case. Anyhow, Solana's mainnet launched in March 2020. It uses a proof-of-stake blockchain with a 400 millisecond block time, which timestamps transactions using a technology called proof of history. This makes it possible for Solana to theoretically process up to 710,000 transactions per second, but its current TPS is between 2,000 and 3,000. In theory, Solana is quite decentralized, as it's secured by almost 2,000 validators. In reality, however, Solana transactions are processed by clusters of up to 150 validators. More importantly, Solana's full transaction history is stored on Google Bigtable. Some would argue that this makes Solana more centralized than meets the eye. It's important to note, though, that this is the case for most crypto projects. The difference in Solana's case is that its blockchain is infamous for experiencing frequent outages. Now, the reasons for these outages vary, but they fundamentally boil down to the fact that Solana prioritized speed above all else. Even so, it's important to note that there have been no outages since February. In terms of tokenomics, meanwhile, Sol is used for staking and to pay for transaction fees on Solana. 50% of these fees are burned. Sol staking rewards are currently around 7% for validators and delegators, with a 5-day lockup and slashing enabled. 7% is roughly Sol's inflation rate too, which will decline to 1.5% by 2030. Sol's initial supply was 500 million, with roughly 37% being allocated to early investors, 25% to the team and foundation, and the remaining 38% to the community reserve, managed by the foundation. Solana raised around $25 million between 2018 and 2020 and raised an additional $314 million in 2021. Two of the largest investors in Solana and Solana's ecosystem were FTX and Alameda Research. They held between 10 and 15% of Sol's supply when they collapsed last November. Concerns about both entities selling their Sol as part of the bankruptcy process is why many, including us, were concerned about Solana. Solana was also FTX's de facto exchange chain, which led to concerns that the project could have been involved in FTX and Alameda's dealings. Thankfully, though, this turned out not to be the case. You can learn more about Solana's relationship with FTX and Alameda by checking out our previous Solana update, link in description. Now, it's been more than a year since we last covered Solana, and boy, has a lot happened in that time. So, shortly after that last video went live, Sol dropped to a low of $8, which in retrospect was the bottom for Sol during this bear market. At the time, though, Solana was in really bad shape. Case in point, it got so bad that even Ethereum creator Vitalik Buterin started publicly supporting Solana. For context, Solana is branded as an Ethereum killer, so the two are seen as fierce competitors. Vitalik's support was therefore a watershed moment. In January this year, Sol's recovery continued due to the emergence of a new meme coin on Solana called Bonk. Naturally, this resulted in an obscene amount of trading fees and a sizable Sol pump. Notably, many crypto media outlets were questioning the pump due to the lack of fundamentals. This made perfect sense considering that behind the Bonk hype, Solana's ecosystem was falling apart. Multiple Solana projects announced they were calling it quits. Almost every month there was another announcement, and there was news of Solana projects shutting down as recently as August. However, other Solana projects doubled down, notably peer-to-peer network Helium. In February, it prepared to migrate from its native blockchain to Solana. The migration was finished in April, and interviews with Anatoly suggest that they're betting big on Helium's adoption. Take notes, folks. Now, not surprisingly, the news about Helium was overshadowed by the announcement that Solana had experienced yet another outage in February. And, to add insult to injury, Solana announced that it would be closing its physical stores in Miami and New York City. Yes, you did hear that right. Solana had physical stores. Things got even messier in March, though, when USDC lost its peg. If you watched our video about that, you'll know that USDC's depegging caused chaos in DeFi. This would have hit Solana harder were it not for the fact that most of its DeFi ecosystem had already gone down with FTX and Alameda last November. And, speaking of DeFi, Orca, the largest DEX on Solana, also announced that it would begin blocking US users in March. Marinade Finance, Solana's largest DeFi protocol, also recently announced that it would begin blocking users from the UK due to regulations. It's safe to assume this was the case for Orca too. Not only that, but Meta also announced that it would be ending its NFT functionality on Facebook and Instagram. To refresh your memory, Meta had announced that its social media platforms would begin supporting NFTs on multiple blockchains, including Solana, back in May 2022. Well, this was axed last March. Now, this is significant because this could result in Solana having fewer users and investors, at least on paper. In practice, though, it seems that these DeFi restrictions have had next to no effect. Sol's price actually managed to double in March, driven in large part by the increase in liquidity following the banking crisis. More about what happened there using the link in the description. Now, in April this year, the tide started to turn for Solana. First, it announced the launch of its mobile crypto phone called Saga, which is now selling at a huge discount. Second, Solana introduced a new technology called state compression to reduce the cost of storage. This upgrade makes it possible to mint NFTs on Solana for next to nothing. Apparently, 1 million NFTs can now be minted on Solana for as little as $110 worth of Sol. This opens the door to more NFT integrations, think giveaways to customers and the like. This could increase Solana's adoption in the long term. As a cherry on top, Solana announced that it would be integrating ChatGPT to make it easier for developers to fetch data and build dApps on its blockchain. The Solana Foundation also announced that it would offer up to $10 million in grants for those building AI-related tech on Solana. Then, in June, the tide turned again for Solana, and not in a good way. The SEC sued Binance and Coinbase and labeled Sol as an unregistered security in both lawsuits. In the weeks that followed, Sol was delisted from multiple platforms in the US, including Revolut, Bakkt, and Robinhood. If you watched our video summarizing the SEC's reasoning, you'll know that it believes Sol is a security because so much of its supply was allocated to the team and the foundation, because Sol has a burning mechanism, and that Solana Labs is creating an expectation of profit with its words and actions. Now, this is a bigger deal than you may think because it means that Sol could be delisted from all crypto exchanges in the US if the SEC wins its case against Binance or Coinbase. Winning against Coinbase appears unlikely, but some would argue that the SEC has a better chance of winning against Binance. This is because of the conditions in Binance's recent settlement with US authorities. More about that in the description as well. I digress. Now, by July, Solana had dusted off the FUD and Sol started to rally again. The launch of Solana's Neon likely helped with this. To refresh your memory, Neon is basically a layer on Solana that leverages the Ethereum virtual machine for smart contracts. This means that it's compatible with Ethereum and other EVM chains. In August, Solana got 2 more boosts. The first was the news that Shopify had partnered with Solana Pay for USDC payments, and the second was the news that Solana-related exchange-traded products were seeing inflows from institutions even while others, including those for BTC, were seeing outflows. Then, in September, we saw what were effectively even more bullish versions of the same headlines. Visa announced that it had begun testing USDC payments on Solana, and Sol officially became the most loved altcoin among institutional investors based on inflows. Alongside this announcement, Solana introduced permissioned environments, making it possible for institutions to create their own private versions of Solana. Now, it's important to note that permissioned environments are not connected to the Solana blockchain, meaning Sol doesn't benefit directly. Newsflash, this is the case for most of the announcements you see about institutions leveraging blockchains like Ethereum and Solana. More often than not, they're using a private and permissioned copy. Regardless, the Sol rally continued into October, which was an intense month for Solana. On the one hand, the trial of FTX and Alameda Research founder Sam Bankman-Fried began. Sol initially crashed when Solana was mentioned, but once the trial was over, Sol started to rally like mad. This was facilitated by what was happening on the other hand, which was Solana's annual Breakpoint conference. The project made way more announcements than I can fit into this video, but the biggest one was arguably the launch of the testnet for Firedancer, a new Solana validator client. Now, to bring you up to speed, for a long time, Solana only had one validator client. To our understanding, a lack of validator client diversity was one of the reasons why Solana had outages. In October last year, a Solana DeFi protocol called Jito launched a second validator client. They have an airdrop going on, FYI. Now, Firedancer will be Solana's third validator client, and it won't just increase Solana's decentralization and security. It will, apparently, make Solana a lot faster as well, though it's not clear by how much. What is clear, though, is that it's going to be a big deal. Firedancer was built by Jump Crypto, the high-frequency trading firm. Lo and behold, the institutional investors continued to ape into Sol in November, with ARK Invest's Cathie Wood essentially saying that Solana is better than Ethereum. To put things into perspective, Grayscale's Solana Trust was trading at an almost 9x premium, signaling extreme institutional demand. But of course, the SEC had to come and crash the party. The regulator sued Kraken for the second time this year and once again referred to Sol as a security. The good news is that Sol was barely affected by this FUD. The bad news is that it's clear that Solana is on the SEC's radar, if not its hit list. More on that in a bit. Now, the result of all these updates is what you see here, very volatile price action for Sol, more recently to the upside. It's possible that a part of the recent rally was due to short liquidations, but the primary factor is likely the one we mentioned a few moments ago, the SBF situation being sorted out. So this begs the question of where Sol is headed next. Well, the answer, as always, depends on two fundamental factors, supply and demand. Some of you might recall that the supply side of Sol is a bit fuzzy. The entirety of its initial supply of 500 million was supposed to vest, aka unlock, in January 2021. Apparently it didn't, and we still haven't been able to find an updated vesting schedule for Sol. What we did find, however, was the vesting schedule for the Sol that was sold to FTX and Alameda Research. This was detailed in a blog post by the Solana Foundation in November. We'll leave a link to it in the description. The TLDR is that most of the Sol sold to FTX and Alameda will vest monthly until late 2027 and early 2028. By most of the Sol, I mean roughly 45 million. This works out to around 500,000 Sol unlocked each month, which FTX and Alameda will likely have to sell as part of their bankruptcy process. 3 things to note here. The first is that FTX and Alameda can and have been staking this vesting Sol, meaning that the sell pressure could be higher. The second thing to note is that even with this additional sell pressure, though, it still works out to only around $25 million of sell pressure per month. Now, this sounds like a lot, but Sol actually issues over $25 million of staking rewards every week. And this pertains to the third thing to note, and that's that it's unlikely that all of FTX and Alameda's Sol will be sold on the open market. Given the institutional interest, most sales will likely take place over the counter. But that's just the supply side of the equation. What's fascinating is that the demand side statistics don't look as strong as you might expect. For starters, the Phantom Wallet browser extension still only has 2 million downloads. This is basically the same number of downloads it had last year. As hinted earlier, the total value locked on Solana is still in the toilet. To be fair, it's risen slightly over the last few months, but it barely registers on the long-term chart. This might have something to do with the fact that most of Solana's activity appears to have migrated to its NFT marketplaces. According to data from DappRadar, there are around 1 million unique wallets using Solana's NFT marketplaces every month. This is roughly double the number of unique wallets that were interacting with Solana dApps 1 year ago, which was impressive back then, given the circumstances. SolScan's analytics tell a slightly different story, however. As you can hopefully see, the number of active wallets on Solana is still extremely low. With the exception of the recent spike, these analytics suggest that the number of active wallets is actually half of what it was after FTX collapsed. But, as we've seen, the fundamentals don't matter when the FOMO kicks in, and it's safe to say that the FOMO around Solana is a former MMA champion. In all seriousness, the extremely bullish sentiment around Solana could be a contrarian indicator. It could foreshadow a much-needed correction for Sol. This is consistent with what we see on Sol's price chart. No matter which indicator you use, it's clear that Sol is very overbought. The RSI being over 90 and Sol's price being outside the Bollinger Bands on the weekly are 2 of many signs that Sol is primed for a pullback. Note that weekly RSI divergence as well. If we zoom out to the monthly, though, we can see that Sol has broken above the Bollinger Band moving average, bull market territory. It's likely that Sol will bounce around this moving average until after the Bitcoin halving, when alts finally take off. Note that a correction to the moving average will be a 40% drop. In the long term, it's possible that Solana is following Ethereum, but 1 cycle behind. Ethereum hit a market cap of over 500 billion during the last cycle. If Solana follows suit this time around, it would translate to a price of around $1,200 per Sol, a 20x move from its current price. Oh, and if you're looking to trade Sol, don't forget about those exchange deals. Now, whether Sol can hit this 4-figure target ultimately depends on Solana's roadmap. Surprisingly, Solana put out a de facto roadmap in a December blog post last year. This is surprising because putting out roadmaps of any kind is another red flag for the SEC, but I'll come back to that later. The blog post in question details the technical upgrades that Solana will undergo. There are two which are still in development: increasing transaction sizes and reducing vote state. Without getting too technical, this will make Solana faster without increasing the requirements for validators. In an October blog post, Solana also revealed a milestone related to its aforementioned validator clients. You'll remember that Solana currently has 2 validator clients and will soon have a third. The Fire Dancer client is expected to go live sometime early next year. Now, the blog post notes that Solana will have a 4th validator client called SIG. This is significant because Anatoly once mentioned in an interview that Solana will effectively be complete once it has launched multiple validator clients. This blog post suggests that it needs 4 to be finished. On that note, Anatoly revealed 3 additional Solana milestones during that Breakpoint conference. The first is that Solana wants to increase the number of leaders, i.e. block producers. This will further increase Solana's scalability and bring it one step closer to being as fast as the Nasdaq stock exchange. The second milestone is a lot more technical and has to do with C-Level, Solana's parallel smart contract processing technology. Now, to be honest, what he said flew over our heads. And the same is true for the third milestone, which was, quote, asynchronous execution. From what we could gather, asynchronous execution sounds eerily similar to the architecture that Aptos has, wherein blockchain roles that are traditionally performed solely by validators are split into different parts. If this is the case, then it suggests that Solana continues to be inspired by Aptos, its biggest competitor. And you can learn more about Solana versus Aptos in the description. Moving on. Now, in a recent interview with The Defiant, Anatoly revealed that Solana is still very focused on crypto payments, but needs some stablecoin regulations to be passed before it can go all in on this niche. Believe it or not, but it looks like Visa and others are already ready to play their parts. During a panel at that Breakpoint conference, a spokesperson from Visa and one from another payments company noted that they're focused on speed and that reliability is more important to them than regulation. The fact that Solana has had no outages since February could therefore foreshadow more payment trials. The scary thing is that these payment companies appear to be obsessed with programmability. The panelists talked about programming stablecoins so that they can't be sent to certain wallet addresses, something that's possible thanks to an application-level technology on Solana called Token 22. This brings me to the concerns we have about Solana. As you might have guessed, our first concern is regulation. The SEC appears to have an axe to grind. Now, perhaps they're just trying to compensate for their failure in regards to their oversight of FTX. Whatever the reason, though, the SEC appears to have Sol and a number of other coins in its crosshairs. As I mentioned earlier, this could get these coins delisted from crypto exchanges in the US, and some crypto platforms have delisted Sol already. Whereas it's easy to argue that Ethereum is sufficiently decentralized, it's much harder to argue this for Solana, given where it is in its development cycle. To the untrained eye, Solana Labs and the Solana Foundation are the two entities driving the expectation of profit from investing in Sol. This is probably why Solana seems to be focusing its efforts on an aspect that requires a very trained eye to inspect: the decentralization of the Solana blockchain itself. If this sounds familiar, that's because Ripple tried this argument in court against the SEC. It's not clear, though, whether it played any role in the judge's ruling that XRP was not a security, but it's enough to suggest that Solana could land a similar judgment for Sol if the SEC actually sues the project. Take a second to consider that Ethereum also has 4 validator clients. The fact that Solana is shooting for the same number is probably not a coincidence. Obviously, this could all be circumstantial evidence, but the fact of the matter is that Solana is facing regulatory scrutiny and also regulatory hurdles to adoption. And this ties into our second concern, and that is Solana's adoption. To be clear, Solana has seen exponentially more adoption than most crypto projects. The thing is that most of this adoption has come from use cases which are slowly being put out of reach by regulators, namely DeFi. The killer use cases that Solana is currently pursuing, namely payments and competing with centralized exchanges, are still being gatekept by outdated regulation. If you've been keeping up with our videos about crypto regulations, you'll know that they may not change in the United States until 2025. This seems to be the consensus, and if the consensus is correct, then that stablecoin bill won't become law anytime soon. Solana becoming a decentralized Nasdaq is even further away. This will require rolling out regulations around tokenization and changing existing market structures. This will take a lot of time. And this relates to our third concern, and that's the possibility that Solana will be taken over by TradFi institutions. I'll reiterate that Solana is easily one of the most promising crypto projects out there. Even so, the fact that it's proof of stake means that large institutions could buy enough SOL to take control. Alternatively, they could just use their own private and permissioned versions of Solana and send the regulators after the public and permissionless version of the project. This is a concern that we have with most promising proof-of-stake cryptos, not just Solana. Thankfully, it's not an imminent threat. So, objectively speaking, Solana is perfectly positioned to be one of the top-performing large-cap cryptocurrencies of the next bull market. Ironically enough, this is precisely because of the thing that made everyone hate it so much, its obsession with making its blockchain as fast as possible. Well, as Anatoly rightfully pointed out, once you solve the scalability issue, solving everything else becomes a lot easier. It's safe to say that Solana has solved this issue, or is at least very close to doing so. This means that Solana will be capable of handling more traffic than any other cryptocurrency at the Layer 1 level. In practical terms, this means that Solana will not see the same Layer 2 fragmentation we're starting to see on Ethereum and other slower but more secure and decentralized Layer 1s. This means that Sol will capture 100% of Solana's traffic, and that means Sol is likely to do very well. And it's possible that the Solana killers will do even better. Link in the description. And that's all for today's video, folks. If you found it informative, be sure to let us know by smashing that like button. If you want to stay informed about everything crypto, subscribe to the channel and ping that notification bell. If you want to help inform others, take a second to share this video with them. And don't forget that the Coin Bureau deals page is where you can find our crypto portfolios, trading fee discounts of up to 60%, and bonuses of up to $40,000 on the best crypto exchanges, as well as discounts on the best hardware wallets too. The link to that will be down in the description. Okay, thank you all for watching, and I'll see you in the next one. This is Guy, over and out.